Welcome to the Econ Buff podcast. I'm your host, Lee Stitzel. With me today is Dr. Ryan Mattson, professor of economics at West Texas A&M University. Ryan, welcome to the Econ Buff podcast.
Thanks. Great to be here.
So, Ryan, our topic today is monetary policy, specifically monetary rules, and their comparison to the use of discretion. So, what are monetary policy rules?
So, a monetary policy rule is just it's a very simple mathematical expression for how you want to target an interest rate, target an inflation rate, target a monetary aggregate. So the most common of this and the one often discussed is the Taylor rule, where the Federal Reserve will determine the federal funds rate based on what they think inflation is doing, what output is doing, while, of course, a lot of decisions go into how the Federal Reserve makes these interest rates. The Taylor rule is one of the most simplified versions, just two inputs, one output. Inflation, output, boom, you've got an interest rate. So that's what generally a monetary policy rule is.
Man, that's fascinating. So you're saying it's prescriptive for policy then, or you're saying it's only trying to be used to describe Federal Reserve policy choices? Like, are we predicting what the Fed is doing with them, or is that something we could actually use in place of what the Fed is doing on a day-to-day basis?
Well, both. I mean, what the Fed is doing on a day-to-day basis, which they employ a whole lot of people for, is to run surveys on. So, okay, let me break it down by the region. Let's say you've got Dallas Fed president. He goes through and he talks to people about what's going on in Dallas, Houston, Austin, El Paso, all the places within that region for the Dallas Fed. He'll compile a report, and this is a very long report. Then what he'll do is he'll have a team of economists put together econometric regressions of hundreds of variables of what's going on in prices and industry and things like that. And then they'll put this all into a report called the Beige Book. Hope I'm right on that. There's a green book and a beige book.
Right.
I'm pretty sure it's the Beige Book.
Nobody remembers which is which.
We'll see which one. But again, these are hundreds of pages long, and honestly, I don't want to read those, and neither does anybody else except the people who work at the Fed. So he sends that up to the board, where we have Jay Powell will sit down with the FOMC, and they'll go through these reports, and they'll make this decision. So the Taylor rule started out from Taylor's original paper as just a way to describe what the Fed is doing. But since it has become so universal, it really is a good way to predict what the Fed is going to do. And you could, if you wanted to, behave according to that policy rule. We could just plug into a computer what inflation and output are going to be, what our target inflation should be, and what our target output should be, and it will spit out a short-term interest rate that we should target.
So that's a question I actually had coming up, and that's one I'm very interested in. Let me circle back around to that, though, and ask you a question. Why do you think monetary policy rules are important, if they are at all?
Well, they're important to manage inflation expectations. They're important because you and I go out and we get a job and we sign a contract. That contract has got a certain nominal level to it that inflation will eat away at. So every year we probably want a raise that's higher than 2% or whatever inflation is. Otherwise, the real wage begins to go down. If we expect that and our employer expects that, then we write the contract, we're both happy. If inflation unexpectedly goes up, then suddenly we're renegotiating that real wage. Suddenly we're saying, well, maybe I should look for a wage somewhere else. Maybe I should try and do something else within the same position to raise my wages. Maybe I should, go out and get another job. If inflation is unexpected, contracts can't be signed. And you can then take this even further out. So consider if you want to build a refinery in Houston. You need to know what the inflation rate is going to be 5-10 years down the road, because that refinery is going to take years to build. It's going to take years to build, and you have a certain amount of return that's going to come from it. If that's all eaten away by inflation, there's no incentive to do anything with it. So one of the problems, for example, in Venezuela, which is one of the current countries seeing bouts of hyperinflation, is that real production then is going down with this, because no one knows what the inflation rate's going to do. Or they know exactly that, hey, it's going to be worthless in a few years. And that changes people's behavior. So having a very rigorous monetary rule that's enforceable, that's credible, is extremely important to setting those expectations and allowing the financial system to work, and therefore allowing the real economy to grow.
So let me see if I have this right. Inflation has certain costs. In the real world, that's the employment story that you were telling. But they also have cost in terms of the uncertainty that people are facing because
Yes.
we don't know what it's going to be. Not just that there's some measure of inflation, some amount of inflation going on right now that presents certain kind of problems. You've eloquently discussed that. Then there's also this subsequent problem of we want to know what it's also going to do. So are rules combating that by allowing us to sort of project what they are, or are they a policy tool in the Federal Reserve's tool bag that allows them to sort of credibly set what the technical term would be like forward guidance, but what the future levels of inflation are going to be?
Yeah, so the Fed's very concerned about forward guidance at this point. They're very concerned about what communications that they're putting out to credibly signal that they will lower or raise interest rates. And what a rule would do would give people a way to predict that. So recently, Jay Powell, for example, lowered interest rates by 25 basis points. He lowered the target by 0.25%, which is not much, but it's still the first lowering of interest rates we've had in a while, because going into Janet Yellen, we started seeing this recovery. The Federal Reserve wants to bring interest rates back up to a more quote-unquote normal level.
So before Powell cut the rates, what were they up to?
I think the target was about 2 to 2.25, and now it's 1.75 to 2.
So historically, what does that look like? Is that a high rate, a average rate, a low rate?
That's still extremely low.
Right.
That's yeah. I mean, compared to rates during Alan Greenspan's time, or even going back to Volcker, where interest rates reached up to the teens, as he was trying to fight off this inflation by raising interest rates. Yeah.
So, given that we're seeing actual cuts in the rate, what is the Fed doing now for setting forward guidance? Are they setting the guidance that we're going to go lower, or we're going to try to stay here for a while?
Well,
Have they made a statement about that?
The Fed wants to be cautiously optimistic. So they don't want to say that the economy is slowing down and therefore we need to enact some sort of monetary stimulus. What they're saying is, we think that something is going to happen a few quarters down the road, so we're going to go ahead and lower interest rates now to try and head it off, but they don't want to lower it too much. What they were doing actually with the 25 basis point lowering, before that happened, the Fed got extremely involved in the repo market, which they haven't done since before the financial crisis. So this is the idea of these overnight repurchase agreements of you inject a whole lot of liquidity into the system through these kind of overnight deals. And the Fed really kicked up their repo behavior. They've really started injecting a whole lot of liquidity even before the 0.25 basis points. Now, one thing is that kind of stimulus is not usually reported on unless you're watching CNBC or you're reading Wall Street Journal. So most people, that kind of flew under the radar. But the basis points, because again, we all kind of know that the interest rate's the target, low interest rates, stimulus, high interest rates, contraction. But they're enacting a monetary stimulus under the radar with these overnight repurchase agreements. That may show up in the monetary aggregates, it may not. We're still waiting on the data. Yeah.
That was my next question. So when we're seeing activity in the repo market and these overnight repurchases, is the Fed then simultaneously doing something else to keep their target interest rate where it's at, or is that not even reflected in those?
Well, it would line up with their stated purpose. That kind of repo transaction, it would increase the money supply, and that would be lowering of these interest rates.
Okay.
The tail rule is interesting because it's monetary policy without money. You've got this inflation and output measure that goes in, and then you're targeting an interest rate, as opposed to, okay, you've got an inflation rate, and if Milton Friedman's right and inflation is everywhere and always a monetary phenomenon, shouldn't it be easier to just target the money supply? And Friedman had his K% rule of money's got to grow at, 2% consistently, and he said this would stabilize inflation. So With that monetary policy rule, it goes more to the issue of what the Fed is actually trying to do. The problem with targeting monetary aggregates is in the late 70s and early 80s. The simple sum measures that we use, you add currency, demand deposits, checking account, things like that, all together into one big lump sum. They divorced themselves from inflation. The correlation went to zero. It became insignificant.
So theoretically or in reality?
Yeah, empirically, in reality,
Really?
with the data. The money supply, M1, M2, did not line up with the inflation rate. And you can see from kind of these other faulty measures, for example, monetary base in 2009 exploded to this high level, but there was no inflation. There was no inflation associated with it. So that's why we focus on these interest rates, because the money supply is seen as a bad measure. Now, and we've talked about this before, and I know then, my particular obsession is you go to the Division monetary aggregates. And these are aggregates that not only add the money together, but price it using the interest rates. So if the Fed then injects a bunch of liquidity through repurchase agreements, it will not only capture the liquidity level that's going into the economy, but that liquidity level, it's actually more of a liquidity value because it's priced based on that interest rate. So
it's almost surprising economists don't find that more natural given our obsession with pricing and prices of everything.
Well, it's hard to understand. And we don't tend to adopt things that are difficult to understand. We were on the gold standard the gold standard, by the way, is a monetary rule. I mean, you have a certain amount of gold that you tag your value of money to. And that value of gold is not going to grow very quickly. But the thing is, even on a gold standard, we had very, very volatile inflation because the money is a service. It's not a good. You have to divorce the idea of gold being a commodity and money therefore being a commodity. Money is the service that gold provides. So we had this volatility during the gold standard era, and finally we had when we began to divorce ourselves from the gold standard, we actually had an amazing amount of inflation stability. Now you can see this in micro world, not microeconomics, but you can see this kind of on a small level with, for example, Bitcoin. Bitcoin has a money growth rule. So when they created this algorithm, they misinterpreted Friedman's work. And so Friedman said K% grows at 2%, say, every year, forever and ever. So Satoshi Nakamoto, who wrote his paper, misinterpreted the K% rule and said, there's got to be a solid level. There will only be, what's the number, 21 billion Bitcoin, something like that.
Right.
There's some level that it
cap.
grows to, a cap. Well, the problem is when you start to get, say, an economy as large as China, and they decide they want to join Bitcoin, so let's say that's just another, 50 million people who decide.
Yeah,
and that's,
all?
Just 50 million, right? Then you're going to get this huge demand swing in the value of Bitcoin.
Yeah.
Because suddenly you now have all of these people wanting to use that service, and so demand increases, what happens to price? Goes up, right?
Right, especially if there's a fixed amount.
Yeah.
So suddenly that increased demand for it makes that Bitcoin more scarce. Same problem when we get to the gold standard if we're following that.
So there's no way then to increase the money supply. That's what the Fed can do, is they can react to, say, a lot more people using dollars. They can react to those fluctuations. And that's what they've been doing. And we see that in the great moderation and the stability of inflation rates that we have now. It's just that short-term interest rates, at least until they hit the zero lower bound, have been a very useful target. I would suggest, and this is research done by McCallum, and then you can look at some of the works of William Barnett and things like that. If you adopt a money growth rule that actually is about money, you can target inflation better. But for now, short-term interest rates have done pretty well.
So it's fascinating then we're seeing a couple of things pop out, which is monetary policy rules are everywhere. We like to point at Taylor, but you're saying there's a monetary aggregates rule from people like Barnett. Cryptocurrency is a certain kind of monetary policy rule, as is the gold standard. Yeah, so that's fascinating. I'd like to return to the Friedman. No, you're doing a great job. You're right on target here.
Sorry about the derailing the train of thought there. Yeah.
No, I thought it was great. So I'm interested in sort of the K% rule. My understanding there is Friedman's logic is we don't want to try to move the money supply inflation around in response to what the economy is doing. We're more interested in reducing the uncertainty that you've already introduced. So talk to us briefly about how monetary policy rules deal with things like uncertainty and dynamic inconsistency, and how discretionary policy can't do that.
So, yeah, I mean, that gets to, I think, the heart of what you're asking here with the rules versus discretion debate. What do the rules do and what does discretion do? So if the Fed's using discretion, they may decide to lower interest rates despite the fact that inflation is very strong for other reasons. Discretion just means they're going off script. They're going off of, okay, we had this inflation target, but for whatever other reason, we're doing something else. Yeah.
So am I understanding that right? You're saying the default is to follow monetary policy rule, and then the Fed does something else, and that's what we call discretionary.
Yes.
How would you distinguish that from what people like John Taylor call unconventional? Is that the same as discretionary, or can you be discretionary but be conventional? Question out of left field, I understand, but
usually when I hear unconventional monetary policy, that's more to do with the Fed is using instruments that it hasn't used before. And that would then be outside of the rule, right? If they're following a Taylor rule there. That'd be outside the interest rate targeting that they do through the increasing or decreasing of money supply.
Okay, so that makes it clear. So if I'm following the rule, that's rules. If I'm still moving around money supply or targeting interest rates, then I'm talking about discretionary policy. If I'm talking about unconventional, now we're talking about things that were policies enacted mostly in response to the zero lower bound.
Yeah. So take, for example, the People's Bank of China, right? I mean, seems very popular these days to label them as currency manipulators. Well, we're all currency manipulators, sure.
Yeah, that's true.
But the way that they do manipulate that currency, instead of, say, targeting domestic inflation as the U.S. would do, as New Zealand would do, as the U.K. would do, they do consider domestic inflation, but they also consider their export markets. So they also bring into account their exchange rate, and that is something that would be outside the Taylor rule. That would be considered unconventional based on at least the modern macroeconomic theory. I mean, it's been done in history, right? In Latin America, East Asian countries, African countries. But these days it seems to be the orthodoxy to target the short-term interest rates to stabilize inflation.
So given that you sort of have this dichotomy of rules versus discretion, and now I'm beginning to wonder if that's a bit of a false dichotomy, just sort of historically, how has the Fed used monetary rules? Do they explicitly use them, or?
Yes. If you think back to, say, the Great Depression, one of the big mistakes that the Fed made, that Milton Friedman points out in monetary history of the United States, is that they were desperately trying to defend the gold standard. So one of the main causes for the severity and the length of the Great Depression was that the Federal Reserve was contracting the money supply because it was trying to maintain a certain rule that the dollar should be this amount relative to some ounce of gold. And that contracted liquidity, it kept businesses from expanding, put people out of jobs, and then we get bread lines and all of the horrible things associated with the Great Depression.
So it made something fundamental about the economy worse.
Yes.
Okay.
And that's in the case, if you're following a bad rule, then discretion might be a good idea.
Right.
You get that Fed chairman who comes in and says, well, maybe we shouldn't, maybe we shouldn't target the gold standard. And then after the Great Depression, you had kind of the Bretton Woods system, which was this idea that we're going to stabilize U.S. currency and foreign currencies officially pegged to gold, but in actuality pegged to the U.S. dollar. So the U.S. dollar became the de facto gold standard for the 40s, 50s, 60s, and into the 70s. And that was the rule again. And then countries like West Germany at the time, England, they began to chafe at the chains that they had based on this monetary policy rule of we need to be pegged to the dollar. We need to have this amount. And so they began to use discretion, and of course their discretion became their rule. They started looking at their own domestic inflation rate. Forget tagging to the dollar. Forget this currency peg that we have. We're going to focus on our domestic inflation in the same way the U.S. focuses on its domestic inflation. Then in that sense, the Bretton Woods system then, collapsed or changed, however you want to put it. But other people began maintaining their own currency with their own particular rules and their own discretion. All of these central banks have a rule. They have some kind of target that they want, and when the information comes in, then they go with it. So output is this far from our potential GDP. So we need to increase the money supply, decrease the money supply in order to lower those interest rates or raise those interest rates at whatever level you want to be at. And it's much easier and much more simple to say, hey, and when everything's fine, just follow the rule. Let the computer calculate it. It's when things are not fine that you really start to see more discretion, that you really start to see Ben Bernanke, for example, in around 2008, you had the consumer price index of inflation going up because of oil prices increasing that summer during the 2008 election. And then you had the GDP deflator going down. So you had two different measures of inflation going in opposite directions at a very key point in 2008 when, the recession is really starting to gear up. The financial crisis is in some of the worst months it's been in. And so then, first of all, which inflation are you going to use? Because this was something Bernanke was criticized for, because Bernanke was looking at the GDP deflator and then the PCE price index, which were both going down at that point. And so for the Fed, generally if you see output going down, inflation going down, just inflation or deflation, it's easy, monetary stimulus. On the other hand, you could get stagflation. Right. You see inflation going up and output going down. Yeah. And then that decision is much more difficult, because that's the decision that Paul Volcker had in the early 80s when he decided he was going to jump up the interest rates, fight inflation, and, oh, by the way, contribute to a fairly horrible recession in 1980-81 that cost Carter the election.
So stagflation is kind of worst case scenario,
yes.
Just economy-wide, but for sure for Fed policy as well. So I'm fascinated then, because you're making the point, I like to think when I'm thinking about this scenario as the Fed and other central banks mostly engage in discretionary policy. But you're saying they're following rules a lot of the time, except when things get bad, which a cynic would argue, that's the same as not following rules at all, right? It's easy to follow the rules when things are good.
Well, that's in the Taylor 1993 papers. He looks at the history of it, and he says, you know what? You don't have to do absolutely everything that the Fed is doing and calculate absolutely everything the Fed's calculating. You don't need integral calculus to do this. You can find a very simple algebraic rule, and you'll be right most of the time. And the Taylor rule has been surprisingly consistent in being correct. The weird thing, even in during the Great Recession, the Taylor rule actually suggested a negative interest rate for about 2 to 3 quarters in 2009.
Right.
Which is something, before 2000, well, not unheard of, but it was something that most economists would no, that's weird. We want the zero lower bound. Well, now negative interest rates seem to be discussed on a daily basis.
Right. I was going to say, we've read some stuff from the Federal Reserve claiming that that's a point against the Taylor rule. And yet
I disagree.
And that's my position as well. And I can send you that report. That's from the 2017 summer report. When Janet Yellen was still the Fed chair. Mm-hmm. And that report makes the point that we have to add discretion to rules, because the Taylor rule suggested a negative interest rate, and I scratched my head at that. Mm-hmm. In 2017, that's recent enough to know better. If somebody wrote that in 2009, maybe we would be sympathetic to that argument. But
well, and that's where the issue of negative interest rates becomes kind of confusing, because we're talking about the federal funds rate, the kind of lending rate that the Federal Reserve gives to banks, or at least something similar to it. What an actual negative interest rate would look like, if it were to be put into action. It wouldn't be the federal funds rate that would go negative. What it would be is it would be the interest rate on excess reserves. So what that would do in that sense then, instead of violating the zero lower bound, you would basically force banks to pay interest on what they're not lending out. And right now, banks are holding, at the height of the Great Recession, banks were holding $2.6 trillion worth of excess reserves. So that's $2.6 trillion over and above what they are required by law to hold back in case of bank runs and panics. 2.6 trillion, by the way. The economy of the U.S. is about 20 trillion this year. I mean, that's not a small amount. And it's gone down finally to about 1.5 trillion. Now, at the beginning of the crisis, the Fed began paying interest on these excess reserves. And that seemed crazy. Why would you do that? You want them to lend that money out. Why would you incentivize them further to keep it in? No, they're getting this, a very small rate of interest. But okay, there was that rate of interest that they kept on it. But actually, this was a long-run game because, now 10 years later, if they're still holding excess reserves and we need some kind of stimulus from that 1.6 trillion in excess reserves, they can start charging banks that negative interest rate. And that's how it might happen in practice.
And that would be an example of unconventional monetary policy.
That would be unconventional monetary policy, yeah, which may become the new rule, right?
Yeah, so does that policy, does it have a name? Does that, are we identifying that yet? Or is
I
that
don't
sort
think
of something
so.
in theory?
That one has not come out yet. I know the Fed is doing it because they're still charging that excess, or not charging, excuse me, they're still giving that excess reserve rate. So they haven't made those rates negative yet. But that would be a little more subtle than turning your short-term rates negative, which at this point Germany and Japan and Switzerland have done.
Right.
So yeah, it's very possible.
That's sort of fascinating because when I was observing paying interest rates on excess reserves from the Fed to the banks, I was sitting here thinking, well, wouldn't it be simpler if we did things such that we cause those banks to always be holding right around the reserve requirement ratio, because that makes the mechanism clearer. But what you're saying is that actually has become a policy tool for them.
Yes.
Another weapon in the arsenal for the Fed. Yeah, that's a fascinating thing I hadn't really thought about before. So we've kind of addressed this question of how have they behaved relative to rules. And if I can summarize, correct me if I'm wrong here, when things are going good, they act like the rule is exactly what they're doing. Now, when you say things go bad and they don't act like what the rule is prescripting, is that any recession, or are we just talking about the real big markers, the S&L crisis?
We're talking real big markers. So 2001, for example, was a garden variety recession. We had Enron, we had September 11th, and even before that, there was softness in the market. So, quarter four of 2001, people started kind of panicking and thinking, okay, we're going into recession. And then the Fed immediately stepped in with lowering interest rates, and then we get to the fiscal policy realm, which is, more your area, I guess, there. But then you had, the Bush tax cuts. And that did what it was supposed to do. It did exactly what it was supposed to do. It headed off the recession. There was a recession. There was certainly a blip in unemployment and a decrease in output. But then by 2002, 2003, we're back to business as usual. And so then Bob Lucas, Nobel Prize-winning economist, gets out there and in his Irving Fisher moment, Irving Fisher, I'll get to that in a minute. His Irving Fisher moment gets out and says, "We've tamed the business cycle." Yeah. And
bold.
Bold statement in 2003, and then 4 or 5 years later it becomes a problem. Which is much like Irving Fisher saying in September of 1929 that the stock market has reached a permanently high plateau. Irving Fisher was a great economist, a magnificent statistician, and of course he's remembered for one silly quote.
You can undo a good career really quickly.
Yep.
So
that's with the monetary rule, going back to Lucas, then yeah, with monetary rule, we've tamed the business cycle. We know exactly what to do. But then when you get to 2009, when you have the liquidity freeze and the meltdown of commercial paper and overnight repurchase markets, then, yeah, people tend to get more creative after that because we've lowered interest rates down to zero. Now what do we do? Where do we go?
That's our low rates causing excessive risk search rate. So,
Yeah.
If the Fed then is behaving like the rules are in play during good times and not during bad times, we almost got John Taylor as the Federal Reserve Chair.
Yes.
He was a finalist, and I was crossing my fingers and crossing my toes and praying to all that is holy that we could get him, just so I could see what would happen. You think John Taylor then follows the rule better? Does he follow the Taylor rule? He fires all the Fed staff and just the measurement people stick around?
I don't know if he'd fire all the Fed staff. I think he'd definitely keep them on to help him confirm the Taylor rule and make sure that it's functioning smoothly. But yeah, I'd say he'd follow the Taylor rule. And oddly enough, like all of the chairmen and the chairwoman before him, Janet Yellen raised interest rates. Well, she was raising interest rates at a time when the Taylor rule prescribed raising the interest rates. Bernanke, Greenspan, Volcker, they all behaved, or at least their behavior was explained very well by the Taylor rule. And so I don't see why he wouldn't. I mean, he could go in and, they do the FOMC thing and they all talk about, well, we think this and we see some softness in this part of the economy and manufacturing's down, but everything else seems to be up. And then, he'd say, okay, give me output, give me inflation, and by the me rule. That's what I was waiting. I really wanted to guess so I could see the FOMC minutes where he goes, well, by the me rule, we should lower interest. But
if I were John Taylor, that's the only thing I would call it.
Yeah, he would. I do believe strongly he would follow the Taylor rule much more closely than some of the previous Federal Reserve chairmen. And in fact, if we were looking at now, actually by the Taylor rule right now, we're about 50 to 75 basis points below where we should be, according to the Taylor rule, based on the low inflation that we have and the high output that we have. So you would still have this conflict between the federal government right now that is or has pushed a fiscal stimulus in 2017, wanting some kind of complement to what they're doing as well from the Federal Reserve with lowering interest rates. But with what the Fed is seeing, the rule is going to say, no, we're at a point where we need to raise interest rates. So that brings up an issue of, what Jay Powell was doing this past meeting, because, he seemed to have been following the rule. Yellen seemed to have been following the rule. And then what's changed now? What is he seeing that we're not seeing on the horizon? And there was even a paper out that, trying to see if the Federal Reserve has recently been reacting to tweets.
The independence of the Fed is a big topic
tweets.
right now.
Yeah. So the question then has come up: is Jay Powell as independent as he should be as a Federal Reserve chairman? I'll give my opinion on that. Yes. I think he is still very much independent, because while it doesn't look good for the Fed's credibility that we have pressure from the federal government and it seems that they're responding to it, at the same time, going kind of outside these rules, the yield spread, the difference between a 10-year bond and a 2-year bond in the U.S. has gone negative, which is to say the 2-year bond is paying more than a 10-year bond. Short-term rates or short-term savings are paying more than long-term savings, which you shouldn't have,
so
right?
Do we observe that historically? That seems wild to me, that we would look forward and say 10 years might return on this should be lower than something I hold on for 2 years.
Yeah. Well, so what that is, that's showing some softness in the market, and it's showing that, at least bond investors don't seem to be optimistic about the future. And the thing about, and this is one of those great macroeconomic tea leaf arguments, we know it's true, and people have argued why it is or why it isn't. And of course, Lucas would say that, hey, now that we're focusing on it as a measure, it doesn't matter anymore anyway, because then we're all going to get used to it.
Well, once we take things into account, you can't use it to measure the behavior anymore.
But since the 1970s, whenever that yield curve has gone negative, within 4 quarters, there's a recession. So
that it's negative at any point, so it inverts once and that's it,
If
or does
it
it have
in-
to stay for a certain period
no,
of
no,
time?
no. It just the first.
So we've already
inversion.
seen that.
Yeah, we've seen it.
So open your crystal ball and look
Oh.
inside, and so it's recession in 2020.
Yes, I would argue because I'm sorry. Let me be unconventional here. I was looking at inflation indexed bonds in quarter one of 2018, and those inverted back then. So my crystal ball anyway is recession in quarter one or quarter two of 2020.
That's pretty precise.
And I'm sticking to that. If we go by the traditional measure, then we're in quarter three now, going on quarter four. So they're saying maybe later on in 2020. So
But you're sticking to your guns.
I'm sticking to my guns on this one, and I think Jay Powell is backing me up because I figure if Jay Powell was thinking, well, let's see what happens quarter 3 or 4 of 2020, he wouldn't be lowering interest rates.
Yeah, he'd just be working in the repo market.
Yeah, he'd just be working the repo market for a bit.
So for our listeners, there's their insider information on what their investment should be doing for the next year. So we're not all theory here at the Econ Buff. We're doing some practical things for you.
Do keep in mind, I'm an excellent macroeconomic forecaster. I have predicted, let's see here, 9 of the last 5 recessions, as all good macroeconomists have done.
That's a classic there. So you mentioned in passing that Powell is more or less following the rules in your estimation, and he's looking fairly independent. I heard an argument recently that said the fact that Powell is reacting to the economy, but the economy is being impacted by the president's tweets, means that the president maybe the independence isn't broken, but that there's some weakness there. I don't like that argument very much, but do you see any truth there in sort of the impact of Twitter?
There's always going to be that question. I mean, there were stories of, if you read Paul Volcker's biography, there are stories of where he talks about some people will say, well, the president would think it'd be very nice if you did this.
Really?
Yeah.
So this president is not unique in the way that he's manipulating
unique in
the
that.
Fed.
He is, I think, a bit more blunt than others.
Well, we can observe it publicly because of the medium, but instead it was a secret letter back in Volcker's day.
There have also been, the Federal Reserve and the federal government generally work together. And generally, the Fed will, like especially in 2008, 2009, the Fed coordinated with Treasury. You had, Ben Bernanke and Tim Geithner and Hank Paulson coordinating their actions as the crisis was unfolding, and we're actually reading a book written by them about the financial crisis in my money and banking class next spring. So I'll go into that in more detail.
So was there any conversation about that not being independence, given that the Treasury and
Well,
the Fed
at that time, no one cared, right?
I
People wanted to stop the
don't
madness.
remember. Yeah, I don't remember any discussion of that.
No. Well, you did probably get it from Ron Paul. I'm fairly certain that probably came up then.
But he's not even wrong in that case, right?
Yeah.
So
I mean, there is a certain. I think the main thing is that the Federal Reserve needs to stick to its congressional mandate, and that's something that Milton Friedman also argued for very strongly in People's History. Monetary history. I'm confusing Zinn and Friedman here.
Lay out the mandate for those listeners who are not perfectly clear. What is the Fed's mandate? What's their goal? What are they trying to do?
So the Fed has 2 stated goals of generally maximizing employment, trying to allow for the financial markets to run so that unemployment is low, people willing and able to work are able to find those jobs, and then to stabilize inflation, to make inflation, a nice, boring 2%. We don't want to get rid of inflation. We don't want it too low. We don't want it too high, and we want it expected. We want people to know in 10 years what the value is going to be, or know in 3 months or 6 months or things like that. So the dual mandate, price stabilization and maximizing employment. Since Volcker, though, and this again, I bring this up with my students, the Federal Reserve really has one job, and that's to stabilize the inflation rate. That's what Volcker did, and He did it at a great cost, and everyone respects him very much for it. And all the people who have had his job afterwards respect him very much for what he did, which was fairly unpopular at the time.
Yeah, Volcker's not thought of kindly in the public sphere, I don't think.
Yeah, not really, but he's an interesting, and that memoir is a really good read if you ever get a chance.
So two things then. You mentioned the dual mandate, and you've got the unemployment, you've got the price stability in there, so then that matches our Taylor rule perfectly.
Yeah.
And that's not by accident, that's by design. And then the second thing is, given that we've got this sort of, I'm going to call it a primacy of price stability. Correct me if you think that's wrong. Do you think that's the way it ought to be? Do you think we ought to have the Fed sort of stepping away from their unemployment targeting or not?
I mean, it's my opinion the Fed should focus on inflation. That should be its number one job, period. That's what a central bank should do. They should stabilize money and the value of money. I think the unemployment issue it's a nice idea, and it certainly goes toward, hey, if inflation is stable, then maybe at your discretion you can do some other things. I think the primacy of price stability is absolutely the way to go for the Federal Reserve. We give them one job, done. That's what they're supposed to do. If we want to worry about other things, then okay, then we can bring in the federal government and work on that. So long as the Federal Reserve is behaving in accordance with its mandate and what it was set up and designed to do, I figure, yes, they're independent. When they start deviating from that, like if I start seeing, a whole lot of, rising interest rates during periods of very, very low inflation or something like that, then I start to think, how independent are they? I mean, unless they're trying to reset back to the Taylor rule and then reset back from the zero lower bound.
So it's interesting you mentioned that. I'm fascinated. So my concern as an outside observer, maybe not as close to it as you are, is if you don't increase the interest rates, maybe up around where Taylor is talking about, you start to run out of rope really quickly if something does happen. So yes. What do you think about that idea you just now called it resetting from the zero lower bound? Have we done enough of that, or is there a way to judge that right?
And that's contentious because we've been at that for so long. We were at the zero lower bound for a good 8-9 years before we started coming back up.
So why be at the zero lower bound for 8 or 9 years when there are good markers that in just a couple of years after 2008 we see some good recovery?
So the idea is that you basically make it easier to get funding. You make it easier to get loans because, hey, the interest rate is low, and then you encourage that opportunity. But one kind of the other side of this is that you keep those rates low, and then nobody's going to save because there's no incentive to put your money into a savings account. And you can see this with and I love this, the $100 bill. You have all of these books coming out about how the $100 bill is illegally trafficked throughout the world. And okay, so then for the listeners who don't know, the $100 bill is actually the most common currency denomination out there. There are more $100 bills out there than 20s, 5s, 1s.
Yeah, that's mind blowing.
Yeah, because I don't have a 100 on me right now. Do you have a $100 bill?
No, of course not.
I'm betting that people listening don't have a $100 bill.
10s, 20s in my wallet.
So where are all those $100 bills? Well, and then, if you can't save, if you have like 0% saving, 0% on your savings rates, and you're at really low inflation, well, heck, you hold on to the $100 bill because who knows when you need to pull it out of your closet or your mattress for a rainy day.
So that liquidity argument then.
Yeah, there's all of these $100 bills floating around, not because we have all these criminals who are trafficking in drugs and things like that.
Is that a real effect, though?
Is that what?
The criminal element to the
I'm sure it is. That
but
is
you're
an
saying
effect to it.
It's a secondary.
But I'm saying it's not the biggest part because I think there are a lot more people out there who are hoarding cash because you have to open up a savings account to get a really small rate of interest. And then, of course, you get dinged by fees if, say, you don't hold enough there. And then you've got to go through all these hoops to get your money. So for a low-income household, a savings account just doesn't seem to make sense. And I know that sounds strange when I say that, but keep in mind that 1/4 of all households in the United States are either unbanked, meaning they don't have any bank account, or they are underbanked, meaning they have an extremely low balance on their account. They don't really use those banking services. 1 in 4 households in the U.S.
That's an unfathomable number to me.
Yeah. So
Okay,
what are
so
they
so
doing?
let's
They're holding
unpack that
hundreds.
just a little bit. You've got the unbanked, and that's almost certainly a cause of them not having access or not having a trust of the system or whatever's going on there. But then you have the underbanked. Now, is that something that the banking sector is doing, or can we be cynical and say those people are just not good at saving money, and instead of putting the money in the bank account, they're making poor financial choices? Am I framing that correctly?
Yeah, I mean, I suppose you could go with that, but at the same time, if you think of again an underbanked household that maybe has a low balance, if you're making $15,000 a year and your car breaks down, that's a significant portion of your income and your savings that you have to spend to fix your car that you need. So of course these things come up. Your car breaks down, medical expenses. You need that liquidity, and holding on to a bunch of hundreds in your closet. Let me go ahead and say right now, I don't hold cash in my household in case people are, thinking of, Dr. Mattson's got money. No. I don't.
Dr. Mattson is appropriately banked.
Yes, I'm appropriately banked. So that's, you'll have to rob the bank for that one. And that's the ethics lesson today, right? Okay.
That's covered by deposit insurance, so have at.
Yeah. So these, I can see the incentive for holding these $100 bills. And what that does as well is companies. Okay, that's okay. Poor households. That's not a huge source of investment funding, right? I mean, who cares if they put their $200 savings at Bank of America or if they put it in their closet? Well, at the same time, you get all these reports of Apple and Microsoft hoarding cash, holding billions of dollars in cash.
So I've read that,
and
I've seen explanations. They're not. I'm not able to recall them at this point. But that's really something. That's really an unusual behavior.
Yeah. So a large corporation can issue what's called commercial papers. They're bond, right? So Apple, let's say, times are good. They've got a bunch of cash. They want to make their money work for them like anybody else. We don't have to make we don't have to make payroll until the end of this quarter. But we already have this cash, so you know what? Let's stick it in commercial paper, and we'll get back, 2-3%, and that's nice. And then after 3 months, they take the liquidity out, they pay their workers, and they still have got this nice revenue stream of 2 to 3% that they can do.
Yeah, no losers there.
Yeah. So then during the Great Recession, on the other hand, the commercial paper market, by the way, almost crashed.
Yeah.
I mean, if not zero, very, very, very close to it. And these corporations began hoarding this money. Because again, think about it. If let's say you put that money out in a bond or something, and then things go south, then you don't get that money back. You hold on to it in cash, or even if let's not go the whole disaster route. Let's say the commercial paper rate goes from say 2% down to 0.25. What's the difference between that and a regular savings account, or that and just holding it in a checking account and waiting for the end of the quarter to make payroll?
So if I'm reading the tea leaves, of what Apple and whoever else, I forgot who you said, was holding all this Microsoft, they're worried about the future, is how I interpret that.
Well, yes. Yeah.
It is specifically in financial markets.
Specifically in the financial market, because they don't seem to trust the financial market as much anymore, because they want to hold on to that cash, because at the end of 3 quarters, at the end of the quarter, at the end of 3 months, they don't want their very talented engineers to leave because they didn't get paid that particular month. They don't want them to leave and take all their secrets with them, right? You always want to make that.
But if you're confident that the economy is going to run along smoothly indefinitely, you don't need to hoard against that in order to hold on to your talented engineers. So they're seeing something out there, and maybe business tycoons are just unnecessarily suspicious, and so maybe we shouldn't learn anything from them. I don't see any evidence of that, and so it gives me pause at least.
Well, and the commercial paper's been recovering. Repos have been recovering, but
any idea what the rates are there? Not to put you on the spot, but
no, not really. I mean, I think that's available on Fred. And that's
So we can take a look at that.
Yeah.
So I had sort of one rabbit I want to chase to take us back. You've mentioned a couple times the Green Book, the Beige Book, and the Fed looking around at what's going on regionally, right? So the Dallas Fed,
Dallas, San Francisco, Atlanta,
they're preparing reports. They're passing that on to the Federal Reserve Board, and then they're making decisions. But to me, the Fed funds rate is so blunt. I mean, you're talking about setting that rate and it affecting nationwide. How can it be that we can factor in regional differences? Well, I say, okay, things are looking great in Dallas, but San Francisco, things are really slowing down in the housing market.
Yeah.
At the end of the day, I got to aggregate, and those things are going to wash out, are they not?
Yeah. I mean, at the end of the day, things may be going great in Dallas and terrible in Minneapolis. But what it does is it provides kind of a temperature gauge of where they think the economy is going. So if you ask, a factory in Minnesota, well, how many orders did you take? What did you buy in terms of physical capital and the goods you need for production? If you start to see, say, within these companies, if they begin to kind of slow down, that can be like the canary in the coal mine. You start to, you take the canary down, and if the air is poisonous, canary dies long before you do. So then it's time to get out.
So you're saying certain regions are viewed like this, or certain industries?
All regions are viewed like that.
Well, so I remember hearing, and I can't remember off the top of my head where I heard this, but people saying things like, the Fed is looking at RV sales in Indianapolis or something, as that's some kind of canary in the coal mine's perfect analogy here. Are there really things like that, or is that just kind of?
Sure. Well, okay. So let's take I don't know about the RV sales. I wouldn't be surprised if it's true. But let's take the Dallas Fed president, who spoke at the Econ Scholars Program. I think 2-3 years ago, he spoke for our undergraduates. When we went to the Fed, anyway, he calls businesses in Dallas, and he does unofficial interviews. How are things going? There's nothing quantitative, there's nothing rigorous, there's nothing about that you can stick into GDP. But what you do have from that is, you get kind of that instinct, right? You get that gut feeling something's going well or something's going poorly, and they do want to bring that up because maybe with your monetary policy rule, as we've seen before, hey, the gold standard worked until it didn't, right? Cryptocurrency's money supply growth, the Bitcoin's money supply growth is going to work until it doesn't. The rule may have to change, and this is where we get into the issue of the Lucas critique. If we start to target an aggregate, the markets are going to react, and then that target is no longer going to be useful. We can argue the same thing that, hey, simple sum money measures worked really well until they didn't. And at some point, short-term interest rates are going to work really well until they don't. So having some kind of feel for what's going on may help us tweak the rule or move on to a different rule. And that's where some of the value of discretion lies, that we can look at things and realize they're changing.
So that's a perfect segue into what I wanted to talk about next, which is there's a couple of serious critiques of the use of rules in setting monetary policy. One of those, and I would argue this is the primary argument, is that rules don't account for enough complexity. The economy is so complex, we're boiling everything down, which is why I wanted to set us up with my comment about the tool being blunt anyways. I don't know how much complexity it could handle. But now you've just opened the door for that, and you said, well, the rule works until it doesn't. Let's call people. Let's get a gut feel. Which, to me, the question then becomes the trade-off between, does that handle complexity better? Do you view room for discretion there, and how do you view that trade-off against what rules provide that discretion can't, which is this certainty and limiting our dynamic inconsistency?
Look, all of macroeconomics is reduced dimension, right? You're taking 500 other things and you're trying to describe them with one number. And that is going to be difficult to do. Like, when you make this complexity argument, I think of So a lot of Latin American countries dealt with import substitution industrialization, the idea that they can play with the exchange rates to import heavy industrial factory materials and then start their own car industry. And they want to do that by playing with the exchange rates, which
As if you can, no pun intended, manufacture
right,
the car industry.
Right. But they also do it with an extremely blunt tool. And so in my principles class, what I generally call that is heart surgery with a chainsaw. Odds are you may actually fix the heart with a chainsaw, but you're going to do a whole lot of damage going in. And maybe you won't do so well with the heart either. These kinds of rules are meant to be blunt. The Taylor rule is imperfect in that it's so naive, but it's also powerful in that sense because it's a good starting point. It's a good way to say, this is about where that interest rate should be, but then it's not taking into account, we mentioned before in our discussion before, we have two different measures of inflation doing two different things at a very pivotal point. Or maybe there's stuff in GDP that's not measured that we want to account for somehow. So having the ability to, increase your complexity based on looking at a more micro point of view of what's going on within the different regions, how they are responding to different policies, that does increase the complexity. And the Fed's a huge system, right? I mean, you've got the board, you've got all these regional banks and all these economists and bankers who work there. It is a complex system, but complex systems can be pretty well described by simple equations as well. I mean, every now and then.
Yeah.
There's a certain hubris to it, right? That you think you're the master of the universe with this one particular formula.
We're pulling the puppet strings, right?
Yeah. But it doesn't always work like that. And I think both you and I have read enough Hayek to agree that unintended consequences happen, and they'll continue to happen. And that I think is where the big weakness is of a simple rule. But the big strength is that people can conceptualize it, and they can hold on to it.
That fights the uncertainty. So do you view that as just a trade-off that at different times in different places we would make different decisions? Or do you view that as we probably need to follow the rule because this uncertainty problem is something that we really want to address and the advantages of discretion are relatively small, especially given that we don't know when the rule doesn't work anymore?
Yeah. I would err on the side of following the rule until you get to some kind of extreme state, which would be what the Fed did, right? I mean, we talked about the rule went negative in 2009, and the Fed's like, well, no, maybe this isn't the proper way to go. But then I'm over here saying, no, you should have looked at that.
You and I look back at that and go, and the rule functioned pretty well, right?
It did pretty well.
And we like as humans to point to any situation that we're in and say, this is unique and this is why. Which the rules constrain us on that front a little bit.
I think you need enough discretion to allow for moving away from the rule if possible, or at least allow for critique of the rule. The problem I see with Bitcoin, for example, to kind of go back to that, is it is a computer. You cannot argue with that algorithm that the exchange rate of Bitcoin to the dollar, this is obviously a bubble. We need to do something in order to bring the value down because, you want a stable currency. You don't want it to be too high or too low. It's like the opposite problem of Venezuela with hyperinflation. You get this massive deflation with Bitcoin. But you can't argue with the algorithm. The algorithm is going to keep producing at that level no matter what until it reaches that endpoint, and then it's done. With both, the rules and the discretion, the rules can take into account that times change. And here we have that output and that inflation rate, right, as those are both changing. But we need to be able to critique that rule and make a decision on if it's still functional. Because, to naively simplify Lucas, everything works until it doesn't. So being able to have that flexibility is important, but at the same time, to maintain these inflation expectations that we going back to the beginning here, maintaining these inflation expectations is important. So people know what's going to happen. They have some security of what's going to happen in the future. The rule allows for that. And discretion can go way far the other way, and then we get, markets moving on a tweet. And that's, we don't want that extreme either. You want a nice, stable currency.
So that's a couple of our potential criticisms of rules addressed. I had one more that I really wanted to ask you, which, so this report that I've referenced already, in that Janet Yellen and the Fed released a report, and it includes criticism of the use of rules based on measurement error and bias. Do you think that the Fed can actually mitigate those concerns using discretionary policy, given that they have to use the same measures as you would put into the rules? And if so, how would they do that?
So, no matter what, they've got to have credibility. People have to believe this. It's, the rule gives credibility.
If they have to believe this as in the policy or the rule, or?
People have to believe that the Fed is going to actually enact that policy.
Right.
If Janet Yellen had gone out there and said, I'm going to raise interest rates by, 200 basis points or 500 basis points,
right,
and she didn't do it, then her credibility is shot.
Right.
Because people will be like, oh, she's just talking. Talk is cheap.
Yeah.
The rule allows for this credibility over and above that. They're looking at the measures and they're sitting there thinking, well, GDP is this and inflation is this, and I had peanut butter for lunch today, so I'm going to raise interest rates. People then start to wonder, well, how is he making that decision? How is she making that decision? What went into that? The rule allows for this credibility, and the reason that it's so important for the Fed to be credible is that money itself has got to be credible. The only time a currency dies is when people don't believe in it. This is, you're going to the musical Peter Pan, and Tinkerbell is injured, right? And what do you got to do? You go, oh, clap, so Tinkerbell will live. And of course, if you don't clap, she dies, the play's over. And no. Of
Right.
course, people clap and Tinkerbell survives.
But that would be a credible threat if I would really lose my my experience there if Tinkerbell goes away because we didn't clap.
The U.S. currency survives not because it's backed by gold, not because it's backed by the word of the United States government, not because it's backed by the Federal Reserve either. It's backed because consumers believe in it. And no central banker or government official is going to be believed in what they can do if everyone else suddenly believes, if everyone believes the dollar's going to crash tomorrow, then the dollar's going to crash. Because money relies on providing that service of medium of exchange, unit of account, and store of value. And if it fails in these three things, it ceases to be money. And then we lose it. It's
all
gone.
three of those things, or any one of those things?
Well, so let's look at Bitcoin. Bitcoin is, it can serve as a unit of account, so yay, there's that. Store of value, I'd say as it's massively deflationary, okay. You can store value, unless suddenly it swings the other way, but it works. Now, the medium of exchange is where I would have an issue, because if I have a Bitcoin, I'm not going to go use that to buy a pizza.
No.
Because I think that Bitcoin, if the second I buy that pizza, the value of the Bitcoin's going up and up even more. So heck no.
You're speculating.
I'll speculate. I'll sit on this. It makes it a very interesting asset, but it makes it a really poor money. So yeah, it's got to be all three. It's got to follow all of those functions, or else it begins to fail from its intended purpose. So to keep money credible, the Fed has got to be credible. And if the Fed is not credible, then people start to lose faith in the money as well. And that's one of those reasons, forward guidance is so important. Some of the things that Bernanke wrote about in his academic papers, that you have to be believed. And if you're not believed, then you're out of luck.
To me, that's the perfect summary of what we've talked about today, is sort of the different role that discretionary policy and rules-based policy can play, and it comes down to that credibility. Any final or passing thoughts on today's environment in regard to that, or the use of rules versus discretion? Anything that you'd like to throw in there as we bring this in for a landing?
I do think the Fed has done a good job of being credible. I do think that
It's bold. I like
yeah,
it. Good.
yeah. I think that they have. I think that they are maintaining their independence. I think that Jay Powell has been very careful and measured in his response to some of these pressures. So I think that's very comforting. I think it should be very comforting for markets, because then when he does deviate from what maybe the rules should prescribe, people then believe he's using that discretion well, and that it's not on a whim, that there is some thinking behind it. On the other hand, I'm also a little concerned that if he's going to deviate from the rule, that he would lower rates, because then that means that he's not sure what's going to happen with growth. So hey, we'll all see what happens in 2020. We've had the one of the longest recoveries that we've seen since 2010, and not that time in recovery is any indicator of a recession, but everybody kind of has that gut feeling that we're due, right? And it seems the bond markets seem to think that anyway. So we'll see how the Fed behaves, and I'm interested to see, if a recession does come in, how far down can the Fed go back towards zero, if that does happen.
My guest today has been Ryan Mattson. Ryan, thank you for joining us on the Econ Buff.
All right, thank you very much.